Valens Research, Uniform Financial Analytics.
Apple, maker of iPhones, maker of Macs, services business. I really shouldn't have to explain what Apple does. The really interesting thing about Apple is, one of the concerns that people have had with Apple for a little while is, well, you know what? The iPhone business is saturated, right? They're not going to have massive growth in terms of number of new units sold in iPhones or even in iPads or even in Apple Watches, let alone computers, because they've probably saturated that market. And so people are worried, where's growth going to come from? Especially because of the fact that people look at Apple's financials and see a company who's actually shrunk its assets each year over the last 3 years, which is a glaring warning sign for a historic growth company that growth might be going away. It's only when we look at the uniform accounting data that we can see that not only is Apple an impressively high return business, right? 4 times what as reported metrics show, Apple also hasn't been shrinking. It's still been growing the last 3 years pretty impressively. And because of that, what we can realize is no, because Apple is investing in areas like services, areas like data, it is still building new infrastructure, et cetera, and still throwing off high returns to do it. We can recognize that this actually is still a growth story that now is trading at 24 times. So it needs to grow, and it is growing. Even in the pandemic, right? It was growing at 8% a year, and that's likely to bounce back. Now, the interesting thing is, does that mean that Apple's a buy rating? And so here, let's take a look. If we actually say, Apple can continue to grow at, let's say, an average of, let's just say this year and be overly pessimistic and say 12.5%, right? The only year that it grew below basically 15 to 18% in the last 10 years was in the pandemic. Let's just say 12.5. If it grows at 12.5% a year, return on assets for the business need to be around 48% over the next 5 years for it to be fairly valued, right? At a $2.4 trillion market cap, this is what Apple needs to do. Now, is that unreasonable? No, if I just look, in 2019, it was a 43% ROA business. In 2018, it was a 56 ROA business. This is basically midway between those two numbers. If I were to think about what Apple's doing right now, right, it is true that a lot of their different products are saturated, but it's also true that they are scaling the services business. Those two offsetting things, for us to think that Apple, that's had ROAs decline almost every single year for the last 10 years, could finally find some sort of stability, just like Wall Street analysts are forecasting, it might be a lofty expectation, but it's not unreasonable. This looks like it makes sense. The market gets Apple if you're looking at the right data to understand what Apple really is. And again, that's where it comes down to. The issue is you can't even have the conversation that we're having about Apple if you're looking at as reported metrics, because you would misunderstand if it's still a growth business, right? Trading at a growth multiple. You would misunderstand how good of a business it still is if you're looking at the bad data.
Valens Research, the world's leading source for uniform financial analytics.